With a mission to empower Floridian gig workers to achieve resilient financial security through an accessible retirement savings program, we Team Meteors propose a milestone based retirement plan. Our vision is to ensure stability for Florida's gig workers, addressing both today's economic climate and tomorrow's retirement needs. Good afternoon, everyone. We'll start by giving a background on recent economic shifts' impact on gig economy and the need for a flexible retirement plan. A major population of Florida comprises of gig workers, and 70% of the gig workers face stagnant or reduced earnings due to the pandemic, while high inflation has further hindered their ability to save. The American gig population is expected to reach 90 million by 2028, with many workers experiencing income swings from 5% to over 30%, leading them to prioritize immediate financial concerns over retirement savings. During the pandemic, many retirement funds faced massive withdrawals, hindering future security. We address this problem by a retirement plan tailored for the gig workers.
We thought of balancing three important aspects while designing our fund. First was to generate enough retirement savings for gig workers. Second, provide liquidity during economic shocks. And third, making the fund appealing to the gig workers. With this in mind, we designed our fund by using three-port approach. The first port is the liquid port, which helps during minor economic shocks. The second is the hybrid port, which is for more severe shocks and specific local events like hurricanes. Finally, the third is the illiquid port, which is meant for long-term savings. Our fund will kickstart with a $30 billion state fund, which will be invested into the illiquid portfolio. From the returns, 3.5% will be given back as interest to the state, and 5% will be kept in a permanent port to be used after the $30 billion loan is repaid. Any excess return will be divided between gig workers with a ratio of 1:2 going to the liquid and hybrid port respectively, with a certain cap which will shift the distribution after the port is completely filled. This feature ensures both long-term saving and liquidity. To make the fund attractive, the plan includes inflation resilience, which means the threshold will change every 2 years. There will be no penalty for withdrawals as well. Withdrawals from the hybrid port will also be tracked with James Hamilton recession-based index, making it more transparent to the workers. The extra surplus also makes the fund appealing to the gig workers. Now on contributions. There are four possible scenarios. In the first, contributions are split in ratio of 25:25:45 between the three ports. In the second scenario, if the hybrid port is filled up completely, contribution go in ratio of 25:75 between the other two ports. In the third scenario, if the liquid port is filled up, contributions are split in ratio of 55:45. If both ports are full, all contribution go into the liquid port. The benefits of having three ports are manifold. The liquid port helps addresses minor shock. The fund in the liquid port is also invested in one-year T-bills, which ensures low volatility in the portfolio. The hybrid port addresses major economic shocks. In case of financial crisis or situation like hurricane, the workers can withdraw from hybrid port to sustain their living. Hybrid port also ensure gig workers earn higher returns while balancing liquidity. The illiquid port prioritizes growth and ensure a substantial check at retirement. The illiquid port will leverage liquidity premium to generate higher returns. All the three port thresholds are set to ensure high-ending retirement savings.
We've chosen to go ahead with a passive investment strategy because we did not want our fund to incur expensive fund managers' fee, and research has proven that only a handful of fund managers actually beat the market. Important considerations include liquidity continuum, which considers asset class fungibility and keeps the needs of gig workers in mind. Next is the risk-adjusted returns. We didn't want to jeopardize the savings of subscribers, so only those asset classes which have a decent risk-adjusted returns were taken into considerations. We've also incorporated elements of ESG investment given high climate risk in Florida. We considered the following asset classes and rejected a few of these because of below average returns and concentration risk, like in case of MSCI Emerging Markets Equity and MSCI World Index. We have a moderate exposure in US and emerging markets like Indian equities. US is known as a hub for technological and financial innovation and also appeals to the average Florida gig worker who is familiar with US equities. Investing in India leverages the country's demographic dividends and also role as a major outsource hub, which is supported by the China Plus One strategy of the developed world. Despite the recent poor performance by Chinese equity, we believe China's integrated supply chain and strong commodities market position it for future growth, and Chinese equities would have a promising return in the future. So basically, we ran a million simulation to come up with a Markowitz frontier and chose the point with the highest Sharpe ratio. However, certain thresholds were set up, like the 2% threshold, so that we are able to cover expense ratio and a maximum threshold of 30% to avoid any sort of concentration risk. Without these restrictions, we ended up having 60% asset allocation to Nifty, which faced high concentration risk and ESG risks on account of lax Indian environment protection laws. For our hybrid fund, we have cut the exposure to the private equity and real estate because of the illiquidity. And then we chose the point with the highest Sharpe ratio on the modified Markowitz frontier. Similarly, for the illiquid fund, we ended up with a mix of equities, bonds, alternative investments, and commodities for diversification benefits without sacrificing on the returns. Also, we are rebalancing our hybrid and liquid pots annually.
Next, we'll talk about the performance evaluation that we ran through Monte Carlo simulations. We basically ran 5,000 iterations each and a fund duration of around 30 years. We have considered an higher inflation rate than the historical average of 20 years, which is 2.55%, to account for the current higher inflation conditions. Gig workers in general have low investment rates when compared to an average US citizen, and therefore our model assumes an investment rate of approximately 6.5%. Our fund, being an automatic opt-in plan and considering the additional direct benefits that we are providing through the state fund, we have considered the enrollment of 80%. Assuming the income of the gig worker to be the minimum wage of $13, we estimated the annual income of the gig worker to be around $27,000. On an average, a US citizen expenses around 80% of their earnings, and we aggressively took this number to be 85% for accounting the gig workers. One thing to note here is that we have taken the growth rate for the annual income as well as the monthly expense to be same as the inflation rate. Next, coming on to how we model the minor and major shocks in our model. Coming on to the minor shocks, we set a limit of maximum 1 month expense as the withdrawal limit for during minor shocks. We have modeled this using a triangular distribution in which the mean is 15-day expense. Coming on to the limit on the hybrid pot, we have set a fixed 3-month expense as the withdrawal limit. We have observed historically that we have an average gap of 9.3 years for a major shock to occur, and we have set accordingly the major shock parameters such that we account for these things. Additionally, we have set a limit that within a span of 7 years, we won't have 2 major shocks. Now we stress tested our model based on all the above parameters and found out that a liquid pot and a hybrid pot threshold of $2,300 and $6,000 leads to optimal returns. Next, we considered 3 different types of personas. One, with the conservative income level of considering them as the minimum wage earners, then accounting for tips, and then moving on to the various job opportunities available. We were able to cover 83% of their expenses or the requirements during minor and major shocks, and an ending portfolio value of $262,000 for a worker earning $27,000. Then, as we see an income increase of $35,000 accounting for tips and overtime compensation, we see that we are able to meet more of the requirements during these shocks, and the average ending portfolio value increases to around $370,000. Similarly, for accounting for the maximum value that we consider of $42,000, we see that we are able to cover approximately 94 and 86% during minor and major shocks, and an average ending portfolio of $470,000. We also tried to model the fund's longevity by running 10,000 simulations after the person retires. We considered an average monthly expense of $3,000 and a standard deviation of $500. What we found is that the person with the minimum income level the fund can last for around 10 years, and 16 and 21 for higher income levels.
Moving forward, our risk management strategy is built on a 3-pronged framework: identification, control, and continuous monitoring. We start by identifying key risks and using tools such as conditional value at risk and stress testing. We assess the potential impact through them. For control, we implement dynamic hedging and diversified asset allocation to mitigate downside risk. Regular risk analysis promotes adaptability through periodic reviews, while a dedicated committee ensures that risks remain aligned with the fund's strategic objectives. Following are some of the identified key retirement risk and mitigation strategies. For example, persistent high inflation, we recommend reallocating to tips and educating gig workers to negotiate for income. Interest rate risk is managed with hedges and floating rate bonds. We thank you for providing the opportunity to present our solution. We are open to questions now.
Awesome. Do we have any questions from the judges? No one?
Yes, excellent presentation. Really good approach to answering the questions that you set out earlier. I just want to go to the asset allocation design, the portfolio design. That's, I think, what slide number? I'm trying to get the slide number. It's the one that has portfolio design and implementation, the Markowitz approach, where you outlined your asset mix. The question I have is, I would have thought that you would emphasize the importance of that illiquidity premium and try to find ways for harvesting that. Instead, you use a passive approach, and in that asset mix, you can see the S&P, for example, outperforms the real estate fund, as well as your listed private equity fund, as well as having a lower volatility. So the Sharpe ratio of the S&P 500 suggests to me that you might as well just put all your money in the S&P 500. Why go through the trouble of having this full asset mix with having that particular bit of information, the performance of the S&P? Why not just put all the money in S&P?
Sure, sir. So I'll take this up. Thank you for the question. So the basic fund philosophy is that we are going to do passive investments. So we are not doing active investments of any sort, because we want to save on the management fees. And plus there are idiosyncratic risk with fund managers. Like very few fund managers actually beat the market. So the private equity exposure that we have taken is also through an index fund and not directly the private equity. So you are seeing that the rate of return on the private equity is muted and it's not higher than S&P per se. So the other thing that we had in mind was we wanted to diversify across asset classes. So Kushagra, if you go to 7, I think that has the covariance matrix. Pratik, if you're not this one. So if you see we are not taking a direct exposure, but if you see even precious metal index or say a US bond, so it has a negative correlation with private equity. Private equity, if you see, also has a very negative correlation with say Shanghai exposure that we have through our bond. So basically our idea was that we are not going into the territory of active management. Hence we have chosen passive fund, and in passive fund also we have taken different asset classes, not just because of the risk and return profile, but because of their diversification benefits as well.
Yeah, thanks. And I was being facetious when I asked you that, but you did answer the question. What I really wanted to ask you then, as you think of the passive approach that you're taking, why ETFs versus funds? And I ask you that because what kind of mechanism do you have? Because ETF has the issue with the size that this pension plan may become. It'll probably create issues in terms of your impact you'll have on some of these markets. Why use passive and ETFs in particular versus going through fund managers?
So we are not actually going through fund managers. These are all passively run strategies. One of the key advantage of having an ETF is that you can trade it on an exchange on a daily basis. But since it's a pension fund, and we are not trading it on a daily basis, so we are not actually enjoying that kind of a benefit out of an ETF. So we have chosen to go with this index fund approach, and additionally the churn rate on an index rate that we were getting was quite attractive. So it's around 0.3%. We have done this in one of our slides as well. So implicit trading cost that we assume for each churn is around 0.3%. So we're not spending that much and we are getting the benefits of a passive investment strategy. That is why we chose this approach. Gaurav, you wanted to add something?
Additionally, I would like to add that the funds we are chosen are already quite big enough that they can handle liquidity of Florida safe. So, for example, the S&P fund is already in billions of dollars. So the kind of investment we make ETFs can handle that. Second, we have also considered the implicit trading cost, which Manish mentioned. So on these ETFs, like we can see Vanguard 500 ETF, the implicit trading cost, which means when you have to you have to withdraw, is around 0.17%. So which is kind of we are comfortable with, and that's why we chose ETF over funds, so that we can have quicker access to liquidity as well.
Campus.
Funds over ETFs. Sorry. Yeah.
Thank you guys for presentation. I had a couple of questions. One of them was in the way you defined essentially the contribution, different scenarios. In the beginning, you said the 30 billion, you're taking 3.5% you pay in interest, and then 5% to the liquid. So did this was incorporated in the way you defined the scenarios afterwards, or no, or is just in your simulation numbers and all that, is this 5% is included in all of that, or?
Yeah, so I'd like to take this up. So basically the 5% amount that we are setting, right, that is essentially set so that the fund can sustain after we have returned the state amount of $30 billion. So the idea is we have to return the amount in 2035, and we want to build a corpus such that we can give the distribution benefits after that. Now the idea is we have also set limits on the liquid and the hybrid pots. Once this limit reaches, any distribution money that was supposed to go into the liquid pot would automatically shift into the hybrid pot. Basically, once the threshold is crossed, it automatically shifts to the next liquid pot. So that was a complete idea of these scenarios.
I would like to add this 5%, as Pratik mentioned, is separate from the distribution we are generating. The idea is that after $30 billion is returned, we still have the fund to give this surplus income after 10 years. So this 5% will always be kept in our permanent port so that this return can be distributed. The second thing is that this 5% is meant for lasting long even after the fund be returned. So that was the idea.
Sorry, just to be clear, this 5% is 5% of the 30 billion that you put aside, or this is 5% of returns per year?
5% of the returns that we get on the 30 billion.
Okay, so then if I look at here, you're saying there's 3.5 and 5, that's 8.5. But then on the other part of the presentation, you're saying that the fund returns on average 6.5 on the illiquid part. So how?
No, so that was like the fund returns on an average of 9.5% on the hybrid pot and approximately 11.26 on the illiquid pot.
I see.
This is essentially where we are taking the benefit of the liquidity premium, right? So that is how we are able to generate the permanent pot.
Okay, so I guess I had missed that one. And then one more question is, with regard to simulations that you made, are you can you elaborate whether you included any sort of relationship between withdrawals and asset prices and economy, and or is there's any sort of correlation there included in the simulations or not?
Okay, so if anyone wants to take it otherwise, so basically the whole idea was that we have taken a pretty high volatility, right? We have set a lot of limits while we were choosing the most efficient point from the Markowitz frontier. So the whole idea was that on an average, the simulation would, take all these things into account. Because when we are simulating a year which is not having a major shock, it could very well be a possibility that we are getting very low returns in the illiquid pot. Right, so we thought about doing a bootstrapping method instead, in which we can link both these things, that this is a year with a major shock, we can take the year with low returns. But again, the problem with that method was essentially you can't just say that historical performance is what exactly is going to mimic in the future. So that is essentially how we handle this.
So basically, in an average sense, like we have always taken the returns of any of the asset classes on an average, 10-year basis, 20-year basis. So in an average sense, even in a year, like we'll have a lot of drawdown. The next year, like when we thought of doing a bootstrap method, like we have to simulate that in 1 year the equities may go down 30 or 40% if it's a COVID year, but in the next year it will also bounce back that much. So in an average sense, both of these results kind of were looking to converge for us. So we took the average approach.
Additionally, I would like to add that because for example, we don't have to worry about drawdowns in illiquid portfolio, but we have to worry about that in hybrid port. In hybrid port, because we are not taking alternate asset classes, also we have a lot of exposure to precious metal and negative correlated assets. In when the economy is down and we need fund from hybrid port, we expect that because of this negative correlation, we will be able to serve the liquidity needs, and our fund will not be that much down that we won't be able to serve that. So the idea of including negatively correlated assets was that along with equities.
Rami?
Gentlemen, thank you very much for your presentation. I have a question on the decumulation process here. I'd love if you could walk us through a little bit of your thought process there. I mean, I'm in your main document. I can see the numbers here. There's very different outcomes depending on how, I guess, the income of the participants, right? Which is not typical for pension funds. I mean, typically you try to essentially amortize for a lifetime or have a certain adjustment based on the economic outcome. So walk us through a little bit of your thought process as you were designing this decumulation plan and why you chose to do it the way you did.
Yeah, so I'll take this up. Yeah.
Yeah, go ahead, Manish.
Yeah. So basically, what we did that if at the end of the accumulation period, I have a certain amount of money, like for a worker contributing 27,000 rupees, he'll end up with a 262,000 rupee. So how would keeping a monthly, like the starting monthly expense was $3,000, and we took a standard deviation of plus or minus 500 rupees, and we also incorporated an inflation factor of 3% each year. So if we start spending this money in this, in an average sense, a worker would spend his money in this way. So what we saw that for a worker earning just the minimum age, like $27,000 per year. So even in that case, our fund was like 60% of the time it was able to last a threshold of 10 years. For 15 years, this threshold number was very low, like 9.6% of the time. But that is because of the fact that we are giving him flexibility of we are giving him flexibility of withdrawing whenever he wants for the minor shock. So this was a call that we took, that we are since it's a gig worker and like Florida keeps on getting hurricanes and shocks like this. So for minor shocks, we are not going to impose upon strict penalty. In fact, we have no penalty for withdrawing during a minor shock. So keeping that in mind, we ended up with these numbers. But as the gig worker's skill level improves and he's able to charge a bit of tip, or he's able to do gig works which have a slightly higher amount, then we see that this fund easily lasts them for 10 years and 15 years with a 100% probability of 10 years and 94.3% for a 15-year period.
I would like to add some.
So actually, this is this is in line with no social security benefits. So this is again a bit of our aggressive assumption that in case of a worst scenario where the gig worker doesn't receive any social security benefits, then that would be the decumulation case. So here's the Appendix 33 that shows the decumulation of funds factoring social security benefits, and we see that the mean has shifted a bit to the right. So this positive scenarios does happen with a positive external effect of such as a social security benefit. We have also run a similar sensitivity analysis by varying inflation rate and monthly expenses. The next appendix, yeah. So over here, with a variance in inflation rates, again, the decumulation would be faster if you have a higher inflation rate. And again, as monthly expenses go higher, again you will have this decumulation process faster.
Additionally, I would like to add that our assumptions were very conservative. For example, we didn't take social security benefits. Also, we took the assumption that gig worker salary will increase only at par with inflation. But even if gig worker salary increase 1% more than inflation rate, the fund will last much longer. We have done that analysis with the income growth rate, Appendix 28. If we see that even if gig workers salary increase 1% more than inflation, the chance that like the fund size becomes almost $40K more. So we have taken very conservative assumption, and we believe that workers will be able to earn 2 or 3% more than the inflation rate, and then our fund gives substantial long period like 20 to 30 years, even for the lower income group.
Jennifer?
Thank you. Your presentation was very thorough, very impressive. On the e-liquid portfolio, if you added your weighting to Nifty and the Shanghai index on an absolute return or absolute basis, how much a weighting of that portfolio would be to these two?
So basically, like we can see in the a liquid pot in the equity section, we have around like 35% of our money invested in equities. Of that, the split is like 47% between Nifty and S&P, and Shanghai is 13%. So if I go to Appendix 6B, I think we have listed there the 20-year return of like lot of other funds. So yeah. So if I see here, so Shanghai hasn't actually performed that much better.
My question wasn't about performance. It's
Okay.
how much of the fund is in Nifty and Shanghai?
Yeah, so Nifty was around 40% and Shanghai was about 13% in the illiquid pot. And that number would...
So
So yeah,
if I
after
gave you
35%.
$100 into the liquid pot, how much of that $100 is in Nifty and Shanghai?
So,
So
like
35 rupees is invested in equities, and of that 40% is invested in Nifty 50. So 35 into 40, that should be around 14 rupees invested in Nifty. And I'm
Five-
just
around
trying
five-
to calculate.
$5
35
into
$5 into Shanghai.
Yeah.
So you're telling me $14. So of my $100, I have $14 into Nifty and the Shanghai. I assume that's going to be a little bit lower on the hybrid because I think you have a little bit lower weighting.
Yeah, like the hybrid has more bond allocation to it.
Yeah. As a Florida saver, and you mentioned ESG in your presentation, how comfortable do you think as a Florida saver I would be having $14 of my retirement in the Nifty and the Shanghai?
Yeah. So it was not just one call based upon risk and return. So if I run we have added certain guardrails to our Markowitz, like we limited that nothing can exceed this much. So if I do not have that guardrail, like I told, because that Nifty has done spectacularly well in past 20 years, our portfolio allocation to just Nifty was coming out to be 60% without any restrictions in mind. But as a Florida citizens, I would suspect Indian government laws regarding environment not being as strict as, say, a company listed in US. So we had impose certain guardrails and certain limitations on equities on how much can go to a specific country. So it's just not a plain optimization exercise. Over and above that, certain guardrails have been put in so that money flows into those countries where environmental laws are stricter. And as a Florida citizen, if I am facing a hurricane every now and then, I know that I am investing into those companies which are actually working towards the environment. It's difficult to do on an index level because one, indexes have not started yet reporting ESG scores apart from the Western world. So we having exposure to Shanghai and Nifty. So at the index levels, these funds have not yet started reporting ESG numbers. So we are constantly monitoring them. And as and when those numbers come out, those would be like key part of our decision making on where we are going to allocate our money.
We have time for one last question from Milan.
Yes, I'm always impressed when presentations have risks, and you do have a slide on risk management. Let's go through two of the risks that you highlighted, the interest rate risk and the market risk, and the mitigants you have, and that's also quite impressive that you highlighted the mitigants. You have, you're going to do hedges for the interest rate risk, and for the market risk, you're going to diversify across sectors and regions. Talk to us about that when you've narrowed the options that you have for what you will be allocating into. How will you achieve those two mitigants?
Sure, I'll take this. So actually, for liquid pot, which is invested in US Treasuries, we have a rolling 1 year basis of again selecting those bond assets. So now coming towards hybrid and illiquid pot, which have a bond portfolio, which we are tracking through an index. So in cases where there is a certain interest rate risk, we are more like we are more inclined towards taking a floating rate where we see a period of high inflation or high economic uncertainty, which we are tracking through our index, which we are tracking through our index and simultaneously sending a report to the Floridian gig workers to track their funds investment as well. So in that case, we will be shifting up a part of our allocation towards floating rate bonds. So that's for interest rate risk. As for market risk, which involves diversified asset allocation, so as we are aware of the current geopolitical climate, which is again uncertain. So in cases of this, where a certain index or certain market doesn't perform, we actually rebalance it annually so that it stays in line with our passive investment strategy as well as it balances the risk part. So in that 1 year, we can actually take a stock of what happened in the geopolitical world, take the risk into the account, and construct a frontier, incorporating this, and take the best sharp point at that moment.
Like just to
Additionally, I
add
would
to
like
it,
to.
I think unfortunately we're out of
I would
time.
like to.
But thank you so much. So if everyone can give a big round of applause for the Meteors team.